Okay, in the coming sections, we're going to get really now deeper into actually buying and selling stocks as far as around the analysis standpoint. And there's fundamental analysis and technical analysis, basically two schools of primary schools of thought around that. So the thing that's similar about them is they're both quantitative based, basically means they're math based, right? We're going to look at numbers. We're going to look at the hard cold numbers. We're not going to look at vision and mission statements or whatever. We've done that maybe. This is like, what are the numbers telling us? And that's telling us whether we should do something as far as, math based things, whether it's numbers or charts, in diagrams that are numbers based, of course. What's different between them is fundamentals is looking more at company performance, right? You're looking at how is the company performing here in the recent past or far past too, and will that continue out in the future? What are they projecting out in the future? It's basically pulling numbers or pulling information from their financial statements, things like the income statement, the balance sheet, the cash flow statement, pulling that into ratios that we can easily digest and look at, and then use these ratios from a fundamental analysis standpoint, saying, is company A a better investment than company B based on these ratios? And should we make a buying decision based on that as far as investing in their stock? Where technical analysis is different is it's not looking at the company performance really at all. It's not looking at ratios. The pure technical analysis person say, I don't even care about all this other stuff you've been teaching, Steve. I just want to look at the actual stock performance. I want to look at the chart because I know the stock technical analysis person would say, and they'd be right on this, that the stock market is driven by supply and demand. Somebody thinks the price is going to go up, so they buy. Another person thinks the price is going to go down, so they sell. And that's where you have a meeting of the minds and there's a buy and sell transaction. But either way, there's supply and demand where people have different viewpoints. So if there's a lot of demand for a stock, let's say they did have a good earnings announcement and that causes the stock to rise, well, that's going to show on a chart that something's happening. And so technical analysis is about looking at the charts and seeing by using different things like moving averages or the shapes of different things or the shapes of the chart, looking at different things to see, is this a time when I should be buying now or should I be selling now based solely on what the chart's telling me, right? So you can use them all together, but that's also how they're different too. And you could be just looking at, there are many people, they just look at the qualitative stuff with the companies and they just do fundamental analysis, particularly if they're looking to buy and hold for a longer period of time. But then folks that are want to do a lot of quick trading, scalpers or day traders, where they're doing a lot of frequent trading, they're going to be more gravitating and interested more in the technical aspect of the stock performance. If we look at this another quick way that you might have seen before early on is where we look at qualitative. We're looking to build that watch list. What are some good companies that we want to invest in from a company standpoint? Fundamental analysis is going to tell us what to buy based on these ratios. What are the stocks that seem to be pretty good? What should we buy? And technical analysis will be more about when to buy it based on these indicators saying, now's the time to buy, now's the time to sell, and then later we'll be talking about placing orders as far as the how to buy. And you should also know that, as I mentioned, was, for day traders, they're going to be more interested in the bottom two, let's say, technical analysis and placing orders because they're doing frequent trading versus, let's say, somebody who's more of a buy and hold investor where, they're going to look at that qualitative and that fundamental analysis stuff. Well, knowing when to buy, like with technical analysis, is helpful too. But if you're going to hold something for a year, 2 or 3 or 5 years or more, then it's less important than if you're going to hold that stock maybe for a few hours or a few days. So let's start looking at these key areas of analyzing stocks, fundamental analysis and technical analysis, and you may find yourself gravitating towards one more than another, and that's perfectly fine. They can be used either together or they can be used separately as well too, depending what type of investor and trader you want to be. But the key thing is that you understand them, and so you can make the right decisions in terms of what tools to use and how you want to use them. And that's what we're going to learn about coming up in these next two really big sections around fundamental analysis and technical analysis. Let's look at some ways to value companies as far as like putting a number towards the price we're going to pay for the stock versus, let's say, their earnings or versus how well the company's doing, their future prospects of the company. And think of this as a building block exercise. And we're going to start with the price to earnings ratio, only because that's really the classic ratio. I mean, many times people would buy stocks just looking at the price to earnings, or commonly known as the PE ratio. And the idea of the PE ratio is that you're looking at the stock price compared to its earning. And so a low PE would mean that you're not paying as much for a good earning company. And if you're paying a high PE, then you're paying more or premium for a company. And certainly in in old times, many people would say that's all they were really looking at. I want to buy low PE companies or in comparison to other companies. But in today's world, especially with like technology stocks and some stocks that might not even have earnings or have negative earnings for a period of time because they're in a growth phase, think of the early days of Amazon or Google or others, who didn't generate profits for the first several years, particularly Amazon. You're investing in this wouldn't be as effective a tool. So, but let's look at price to earnings ratio as far as something to understand, but don't use it as a way of like, oh, if this number is lower than another number, then that's the one to buy. You got to look at a whole host of factors. And it's really kind of a building block for other ratios. So the PE ratio comes off the income statement and its most recent stock price. What's our earnings and what's our stock price right now? And it's basically a simple, division. It's price per share. What is our stock price divided by earnings per share. So you're looking at how much are the earnings per share. You have a total amount of shares out there. Divide that, what's your price per share and your earnings per share. And all these things are all public knowledge. You can get them on any, wherever you're investing at, or you can look at Yahoo, Morningstar, any type of investment thing. You can find PE ratios very easily. So you don't need to calculate this manually, or any of these ratios you don't really need to calculate manually. You can find them done for you. So what it means is to think of the price earnings ratio as the price you pay for $1 of earnings, right? So if I have $1 worth of earnings, let's use a dollar versus rupee or pound or whatever else, euro. Let's say you have 1 unit of earnings or $1 earnings, your price, how much would I pay to get that earnings? So if a PE ratio is a 14, it'd say, well, I'm paying in effect $14 to get that $1 for a stock price to get that $1 of earnings. So, pretty simple type of formula. If PE ratio is 30, well, that means I'm paying a lot more to get that $1 of earnings, right? So higher the number or the lower the number, typically the better, but again, it can vary. And so that's the very general rule of thumb, is that shares trading at a low PE ratio are of value. Though the definition of low varies from industry to industry. Some typically have higher or lower, each industry has higher or lower types of PE ratios typically associated with them. So that's why you want to, with ratios, you want to compare versus its competitors or peers. But that's the idea of the PE ratio, is that you're comparing the price to its earnings. Now, what you're not comparing is a growth factor on that. You're looking at existing static price to earnings. So that's where we need a little bit better ratios, and one is the PEG ratio that we're going to talk about. Let's talk about that now as far as price to earnings with a growth factor in there. One of the downsides of the PE ratio or price to earnings ratio is it's a static moment in time. It doesn't really factor in what's the future growth prospects look like. You're just taking a snapshot in time. But wouldn't it be great to see where we're at right now, but see what earnings growth might look like in the future and have a factor in there to get a little bit more sophisticated of a ratio? And thus was born the PEG ratio, or price to earnings with growth, is another way to think of it, but it's more commonly known as the PEG ratio. And those are things you get off, the income statement or its recent stock price. And the formula is you're taking that PE ratio, just like we did. You take the PE ratio, the final number of that price to earnings ratio, and you're dividing that by a projection. So it's an estimate, but it's a projected annual growth in earnings per share. So price per share, E was the earnings per share to calculate the PE ratio. Now we're going to look at a growth rate in earnings per share. What is that rate of growth going to be? And we're going to factor that in to get us this PEG ratio. So what it means is that the PEG ratio is using that basic format of the PE ratio for the numerator, and then it's divided by the potential growth, because that's an estimate of earnings per share, which you'll have as an estimate. Company will provide estimates around that, or there's analysts provide estimates too. And they seem to be very similar, but the PEG ratio is able to take into account the future earnings growth. They're similar because the PE part is the same. What's different is the growth factor. And this way we can now have a numeric number to help compare companies, compare across industries, and have a factor with growth factored in there too, because as earnings grow, our stock price should grow along with it, is the idea. And a general rule of thumb is that any PEG ratio below 1.0 is considered to be a good value. Below 1.0, the better the value. But if you're looking at a value stock, or you're looking at stocks that's above 1.0, it's in terms of the price you're paying for those earnings and those future earnings in comparison, it's not a good value in terms of that comparison. Now, that doesn't mean you're not investing in a high-tech company, that might be growing and has a high PEG ratio, because it's growing or whatever. And so people are paying a premium for that and know they're paying a premium for it, even though their growth factor might be high. So if you look at, let's say, like an Amazon, you might have a high growth ratio, that growth part, but its price for the stock compared to earnings is really high because people really believe in it, or Tesla or something like that. And so you might be overpaying for that, but the idea is, as a growth stock, that might still overcome. But if you're looking at value stocks, looking for stocks that are on sale or bargains, you're looking for things that have a PEG ratio below 1.0 is a great way to start. And the lower that number in comparison to other companies, especially, but the lower that number, the better. With all the other things considered in there, the management, the strategy, business model, the moat, margin of safety, all sorts of things to look at. Those are many considerations, but the PEG ratio is a great way to maybe sort out companies and say, okay, I want to look at companies with a PEG ratio below 1.0, as then looking deeper at those companies as far as, do I want to invest in them? So price to earnings to growth is looking at our stock price relative to its current earnings, and then with dividing that by that growth factor to give us a ratio factoring in future growth. Another way of looking at evaluating or the valuation of stock prices and picking stocks is a price to sales ratio. Not as used as much as a PE ratio, and not used as much as like a PEG ratio for value investors, but it's still very, very important. And you get that off the income statement. You're looking at your sales and the recent stock price. And the formula is the price per share divided by the annual sales per share. So you're looking at it on a per share basis, the formula. But you can find these, they'll say P/S, a P price to sales. And it's like price to earnings or price to book or some of these other pricing comparison to something ratios. And price to sales, you're looking at, what kind of price did you get, or what kind of prices are you willing to pay for $1 of sales is one way to look at it. And you're really kind of comparing firms based on their sales relative to their pricing in the market. So if you've got a company, let's say, that has a price to sales of 2 or 2 times and another one of 4 times, well, that means you're paying a high price for that 4 times company. And you want to ask yourself, is it worth it to pay for that sales? Is it worth to pay that much? Or is it a better value maybe to go with the 2 times one? So it could be good or bad either way, but the lower the price of sales, you might be a better value when you're looking at stocks. A price of sales that's high might be a higher price relative to its sales. And a lot of people like price to sales. I like price to sales too. Amongst all these ones that we're learning about, all these different ratios taken together, all within the industry, so we keep saying that over and over again. But it's good because when you look at like earnings and things, frankly, there can be a lot of different manipulation around earnings. Some are criminal, and you might hear stories where there's criminal manipulation and hiding things off the books and all that, and that's terrible and illegal. But there's also some manipulation as far as when you receive money and when it's going out and what you're expensing and not. There can be a little bit more. You can play a little bit more with like earnings, and many companies do to hit a certain earnings number. They've projected earnings, and if they don't hit their number, their stock's going down. So you might see a little bit around them. But sales is a harder number to manipulate because, you either made a sale or you didn't make a sale. It's either showing up on the revenue line of your income statement as revenue or sales, or it's not. So it's a little bit harder to hide that or shift it. But it can be done. Anything of these things can be done with magical accounting, I guess. But it's something that's a little bit harder. So a lot of people like price to sales because it's a little bit more consistent of a number and a little bit more reflective of an organization as far as a number. So it's just another evaluation, and a good valuation to say, hey, in order to grow, in order to do well as a company, we need sales. We can always cut and reduce our expenses, and we can do that. But the bottom line, we need to grow sales, and grow sales relative to our price to be a good value company to maybe buy. And if we're not growing sales and our stock price is maybe real high, that might be something to look at and maybe avoid. You're looking for companies with good sales, growing sales, and if their price is undervalued, hey, that's great. Have that lower price to sales ratio. So another thing to look at, something a little more consistent, is price to sales. But I would consider it with price to earnings and some of these other ratios as well. Another very interesting way of calculating or looking at a fundamentally ratio is, and one I like because it's got a funny name, I think, is GARP, or growth at a reasonable price. GARP stands for growth at a reasonable price. And the idea of growth at a reasonable price it's a combination of growth and value investing. Growth being like looking for momentum or stocks that are at a premium and are growing and all that. Where value investing, we're looking for those bargains. Somehow something's happened temporarily with the company and we're looking for a great value buying a stock, that might be undervalued. So it's kind of that combination of looking for these really undervalued stocks and at the same time a stock that has sustainable good growth potential. So it's kind of a nice combination factor of the two kind of styles. And some criticism of it would be that's in between. It's a little wishy-washy, right? It's like you should either be a growth investor or you should be a value investor, right? And actually, a lot of times growth stocks will have become value stocks temporarily because they've had something temporary setback. You know, a biotech company that has something go wrong at a trial or getting approval for some new, you know, biotech thing, or a medical device company, or a technology stock like an internet-based type company or a social media company. You know, these are growth stocks, but they might be undervalued at the moment. So you can have that combination, and that combination of investing, and look for, let's say, technology companies that might be undervalued. But the idea is that you're combining growth and value together. So you're looking for that growth, but you want it at a reasonable price. You don't want to pay premiums for like the high-flying stocks. You're like, no, I like to invest in stocks that are really going to grow, but I don't want to pay an exorbitant price, as in my stock price I'm going to pay. I want that a little bit more margin of safety in case it goes down the stock price. So I want to buy something that's more of a reasonable price, or growth at a reasonable price. It's a little more qualitative based, qualitative, what's the CEO, what's the business, what's the leadership team doing, what's the business strategy. You want to really understand that, as a factor in there. And then quantitative, looking at the numerics around it, you're looking at things like, recent, past, and, projected earning growth. What are the companies projecting as far as growth? What's been happening is the earnings per share, more subdued, like in a 15 to 20% range earnings per share. That's actually pretty good, but earnings per share, in a price, the earnings ratio might be higher than, let's say, a real low value stock, or a real bargain basement stock, but it's lower than growth investors. So the PE ratio is like in the 15 to 25% range, or higher than the S&P 500 range. That might be like, okay, it's not really a traditional value investment. This is where it's kind of in between. But it's better than like a stock that's paying, or that's got a price to earnings ratio of 30 plus, that I know is really not, on sale, so to speak. And the PEG ratio, then we want to be lower than 1. That's our measure. If we look at the PEG ratio lesson, that we want to be lower than 1 to be really considered a value investment, something that's selling at a discount, that it's priced to its earnings relative to its future growth perspective as a individual share basis, price per share, earnings per share, and then the growth factor in there. That's why I like the PEG ratio. And we want it to be less than 1, but we prefer it to be near more of like a 0.5. That's really low, because it really then comes into that whole idea or concept of growth at a reasonable price, right? So if I'm getting a PEG ratio of 0.5, I'm really getting a really good value stock that has really good growth prospects. Then if something that's at 1, or certainly above 1, or at 2.0 or whatever, where I'm not getting a good price for it, I'm really banking on just really extraordinary growth to raise my stock price. So if we're looking at the concept of growth and a reasonable price, a good way to look at it is that PEG ratio, and getting more close to that 0.5. Always a good thing from a value standpoint, but even more so because it factors in that growth rate in there with that. So growth at a reasonable price, think of that concept, different factors you can look at it for there. And I'd say, yeah, leverage that PEG ratio. It's a good way to look at it real quickly. Let's talk about 3 key numbers related to dividends. Now, dividends, as we know, are paid out typically every quarter, and it's just by holding a stock, you get paid out that money in a dividend. And now we're going to use some numbers to see how we can evaluate dividend stocks and what might be a better dividend stock versus another one. But the key is, you have to hold it until the dividend's paid out, right? So let's look at dividend amount, dividend yield, and payout ratio. So the dividend amount is simply how much you are paid per share of stock you own, right? So if it says that you're going to get paid a dividend every year equal to $1 US for 1 share of stock, then that's how much you're getting paid, and it's expressed as an annual number. Now again, it's paid out quarterly, so you get 1/4 of that each quarter, but it's expressed as an annual number when you look it up. And we'll take a look at that, as far as where to see that on a stock quote in a moment here. But understand, it's expressed annually, but paid out quarterly, 1/4 each time. Now, dividends can be raised each year. In fact, many companies are very famous for raising their dividends on an annual or yearly basis, at least somewhat. Some not as big as others, but you can look at and see they can be raised each year. But a dividend can also be cut or eliminated, so that's something to be aware of too. The company does not have to pay a dividend. they should pay a dividend. If they're paying a dividend, then they'll try to keep paying it, but they don't have to. And we're going to learn about a ratio of that dividend payout ratio that's going to help us to determine how likely they are going to be to pay that. And that's coming up at the end of the lesson. So the first thing is, how much am I getting is my dividend, and that's the dividend amount. But the main thing that a lot of people will then look at is the dividend yield, because that's how much you're paid per share of stock you own, and it's expressed as a percentage, right? So instead of saying, well, I get paid $1, maybe that is used as a percentage, that might be 2%. And that makes it easier to compare, because one company could pay you a $1 dividend, another one could pay you a $2 dividend, but because you can buy more shares of the $1 dividend company, as an example, you would actually have more dividends get paid out to you. So that percentage is real important here, and we'll see the example of that. And basically, it makes it easier to compare between investments, and the higher the number, the better. So with dividend yield, you want to higher the number means you're going to get paid more out, and easier to compare. So let's look at an example here on how to find this. So if we look at, let's say, Coca-Cola here on the left, Coca-Cola company, Coke, and when you look at a stock quote, like this is from Yahoo, and they'll be the same kind of thing on like investing.com or different places, they'll usually show where it says forward dividend and yield. So forward means something that's coming in the future, anticipated what the dividend is. If it says something like TTM, you can see right above it where it says PE ratio and EPS, or earnings per share, TTM, that's trailing 12 months. So that's looking backwards, trailing 12 months. But dividends are expressed as forward, what you can expect to get paid, and the yield. So if we look at Coke, you can see where it's 1.68. So for basically every share of Coke that I own, I get paid $1.68 for every share. So if I own Coca-Cola and I have 100 shares, that means over the course of at the end of the year, or over the 4 quarters, I'll get paid $168 in dividends just for owning that stock, just for owning 100 shares of Coca-Cola. So that's great, right? So that's nice. That's the dividend, payout. But the yield is a very important number. So this is, when you want to compare stuff, right? So the yield is at 3.13%. So you could compare that, let's say, to a savings account or a money market account that might be paying you around 1% or less. You can say, well, gosh, I'd be better buying a dividend company and holding it and getting 3% than maybe putting my money in a savings account. And you would be correct on that from a yield standpoint. Now, obviously, companies can cut their dividend or eliminate their dividend, or the stock price could go down, which isn't great. But, Coca-Cola, for example, and others like Johnson & Johnson, they've paid out dividends for decades, many decades. Maybe Johnson & Johnson, I think, something like 75 years or more, right? So, they're likely going to keep paying it. Now, if we compare that, let's say, to Tesla there, on the right, you can see their forward dividend is NA and yield is NA. Well, what does that mean? That means they don't pay a dividend. They're a growth company. They're taking all their profits and putting it right back in the company to try to build more gigafactories and more cars and expand in more markets. So they're in a high growth phase. So they're not going to give us as investors money in the form of a dividend. They're going to take that money they would have given us and put in the company and try to grow that stock price and grow that company. Where Coke is a more established company and less of a growth company, and thus, in order to reward us as stockholders, they're going to give us a dividend. And that's where that 3% comes on the yield. So when you're comparing, let's say, 2 different things, that's where you want to look at is the yield. So let's do that. Let's say, which one of these is better? Remember, higher is better. So we've got KO or Coke at 3.13, their main competitor Pepsi at 2.67. A bond might be paying you 2.75% in interest. So if I own that bond, I'm going to get 2.75% interest. And in money market, let's say we found a decent one that's going to pay us 1.2%. In terms of yield or income, money that they're just going to give us for holding this security, whether it's Coke, Pepsi, a bond, or this money market account, that we're going to get income, which one is better? Well, obviously, it's in terms of that question, is the higher dividend yield. It's the 3.13. If the bond was paying you 5%, you could say, well, the bond is going to pay you more interest. From an income standpoint and a payout standpoint, the bond would be better 5%. Now, with stocks, not only can they pay you a dividend, but their price of their stock can go up, and you can make profit by that price appreciation. Or I'm buying Coke at 53 and it goes up to 103. I made money in the price difference between I bought and when I sell in the future. But if we look at just income, that's where you can use that dividend yield as a real strong thing in terms of comparing. All right, now let's look at dividend payout ratio that we talked about earlier. Remember, companies can eliminate their dividend. They don't have to pay it. They pay it out of their net income. So if a company starts having losses or is really struggling, one thing that they can do is cut their dividend or reduce the amount of payout or eliminate it entirely. Even long-time dividend payers like GE, for example, General Electric, used to pay a dividend for 10, 20, 30, 40 years and not too long ago eliminated it because they fell into hard times. First they cut it and then they eliminated it. So it's not a guarantee that you're going to have a dividend. The dividend payout ratio basically helps us to determine how likely will there be a future dividend. In this case, the lower the number is better. Dividend yield, we want a higher number. In this case, we want a lower number. Because what we're figuring out here is we're taking, as you can see in the formula at the bottom there, we're taking out the amount of dividends that are being paid out. And dividends are paid out of net income, right? Earnings that the company has. So if you have earnings, dividends paid divided by net income, that gives you your payout ratio. Or what percentage of dividends is being paid out of net income. So if they're paying less than 50% of all their net income out in dividends, that means they got 50% other money that they can reinvest or put in cash or do something else with. That's great. That means they're very much going to likely pay out that dividend going forward because they can easily cover it. Even if they're at 50, 60%, that's good. Even up to 70%, that's okay. Some go even higher than that as far as the amount of money paying out. But you start getting above 70%, that can get a little weird because you start getting 80, 90%. Now it's like all your income you got coming in is going right out in dividends. And then sometimes what happens is where companies might even pay higher than 100%. And well, why would that be? Well, they want to keep paying that dividend because if they stop paying the dividend, investors are going to flee, right? They're going to just sell that stock and the stock price will go down, which hurts the CEO, hurts the board of director, hurts people who own stocks. So they want to make sure their stock price doesn't go down and they want to make sure no matter what, they don't want to cut that dividend. But sometimes they're forced to because they just don't have the net income to support it. So you start getting about 70%, start being cautious is what I'm saying. Now some industries naturally have higher payout ratios. Energy industry like oil, gas, or utility companies, tend to have higher payout ratios. REITs, which are real estate investment trusts. There's actually some legal things around real estate investment trusts forcing them to pay, I think it's like above 80% or more typically in dividends that they have to pass on to it because of the way a real estate investment trust is structured. By the way, REITs you can buy and sell on a stock exchange just like any stock. They're just focused on buying different types of properties and things. So REITs, if you're really looking at dividends, REITs can be a good higher paying dividend option and based around real estate. Another one is MLPs or limited partnerships, managed limited partnerships. Those are like oil and gas like pipelines. So either way, no matter what you're looking at, if you look at these numbers for the payout ratio, to get a feel for how likely they'll keep looking and paying their dividends. Let's look at an example of that. Again, I'm on this screenshots from Yahoo Finance. Just like if you looked up the quote on Coca-Cola, you'll see this little ribbon here where in Yahoo Finance they'll state statistics. On other quote sites you might find in another spot. But what you're looking for is payout ratio or dividend payout ratio. And on Yahoo Finance, if you go to the bottom right, after you click on statistics, you'll see where it says dividends and splits, and you can see these different dividend rates and yields. The forward dividend rate we looked at, 1.68 versus 3.13% yield. You can see trailing, and that they show like what was it for the last year, and you can see it was a little less, 1.67 and 3.0%, so that's okay. And then the 5-year average dividend yield, so on average yield is about 3.22, so all right around there. But the key thing we're looking at here is the payout ratio at 82.27%. Now that's getting higher. Remember, we were getting cautious once it got above 70%. But with a company like Coke, which has a lot of money in cash and a very established company, they're very strong chance they're going to be able to maintain that payout at a high ratio. A company without as strong a balance sheet, they're not going to be able to maintain that for very long, or it'd be something to be really concerned about. But it's something when you're comparing stocks, you could say, oh, well, this one has a great dividend yield, but the payout ratio is high, so I'm a little worried, especially if they're on tough economic times, so it's something to be careful with. If we looked at Coke and Pepsi side by side on that bottom right, dividend and splits, you can see that Coke pays the higher dividend yield. So you make more per share of stock that you own of Coke at 3.13 versus Pepsi at 2.67%. But now let's look at their payout ratios. Coke's at 82 and Pepsi's at 71%, a little above 71% payout ratio. Both on the higher end, both established companies, but you can say, well, Pepsi's got a better chance just based on that number to keep paying out that dividend, right? So, but again, these are both pretty close. Now let's compare Coke, let's say, to Apple, right? There's a few technology companies like Microsoft and Apple that pay out a little dividend. And you can see with Coke, I'm going to get a bigger dividend yield, 3% again, versus Apple, it's not even 1%, it's 0.56%. So you get a little dividend as in terms of a percentage, paid out from Apple. Now let's look at that payout ratio. Coke is at 82%, Apple 15%, right? Apple, growing company, super profitable, high margins, billions of dollars of cash, they're just flush with cash. So the chances of them cutting the dividend are very remote. Only 15% of their whole income, and they have massive net earnings, is getting paid out in dividends. So Apple is very unlikely to cut its dividend. If anything, Apple might be more likely to continue to raise its dividend and maybe raise it faster than Coke because they have more room to grow with that. So there you have three real important things when you're looking at dividends. How much is the dividend I'm going to get paid out per share of stock? And I think the real two most important one is, what is my percentage? What am I making on a percentage basis? That's the dividend yield. And then can they keep paying that dividend? And that's the payout ratio. This is all very important when you're looking at dividend stocks. If you're looking at growth stocks or stocks that don't pay a dividend, then none of this matters. But if you're trading very frequently where you're not going to hold a stock to actually get the dividend, it doesn't matter. But if you're looking to buy dividend stocks and hold them so you can get that income and get that dividend, look at these three numbers, particularly the yield and the payout ratio. So when you're looking at like a margin of safety when you're investing in stocks, particularly like a value stock that might be selling at a reduced price because something is going on with the stock, you want to make sure that they can pay their bills. Just like you or me, it's important that we're able to pay our bills. And we have actually measures that we can use this to evaluate different companies in their ability to pay their current bills. Think of it as what we would call the current ratio and quick ratio, and these are margin of safety tools we're going to learn about in this lesson. And that's the big question. Can a company cover their short-term debts, or we might commonly know them as bills, but in the finance parlance, we would consider them short-term debts that are usually less than a year old or are coming due within a year, versus a long-term debt, something that's going to be due to pay a year or more out. So we're looking at short-term, something that's coming due right away or within a year. So what happens if a company can't cover their debts? Bills are coming due, they got to pay them. What do they do? What are some things they can do? And they're not good things, particularly for our stock price. So they can reduce their expenses. There's different ways to do that. One is to lay off people. That's always ugly and nasty, especially if you're one of the people getting laid off. So they can reduce their expenses. They can also reduce their expenses by spending less on really key and important areas, such as training for their team members, marketing, research and development. All these things can have longer term consequences as far as having the company be successful going forward, but they might need to reduce their expenses in the short term to meet these obligations. Another thing they can do is sell off assets, right? They can sell off plants or factories or entire divisions they can sell off. They can do all sorts of things to sell off different assets, equipment, all sorts of things they can do. Again, thinking long term, these might have been assets that could have been used in the future, but now we need to sell them to cover our short-term obligations. Or they could take on more debt. You see that happen, right? Where companies need to service their debt or pay their debt, and so they take on more debt with a longer term rate, as far as term being when it comes due. So they use the longer term debt to cover the short-term debt. And we know if a company never really turns it around or never really gets that under control, it's almost like a Ponzi scheme where at some point, all this debt's going to come due and they're not going to be able to pay it, and that becomes a problem. Or they could cut or eliminate their dividend. Remember, dividends are payments that are getting paid to shareholders, people like you and I who own stock, as part of our compensation for investing in a company. But a company can decide what they want to pay in a dividend. They don't have to pay a dividend, so they could reduce that payment amount, or they could eliminate that dividend altogether. That way, cash is not going out of the company to pay us. They could use that cash in the company to pay their short-term debts. Might be good for the company, but not good for us as far as stockholders. So when they do these things, what can happen? What can happen if they can't cover their debts and they do some of these things? What are some possible results? And significantly, what can happen is the stock price can go down. Sometimes it can go way down when they start doing these things, particularly if they're cutting a dividend, where they where they're taking that money away from shareholders. Sometimes you can have a little opposite thing. This is the unfortunate thing where you see companies announce layoffs and their stock price goes up because they're cutting their expenses, but the shareholders like the idea that they're not getting their dividend cut, or they're doing things to try to help improve the company from a shareholder or owner standpoint. That doesn't help, of course, the poorer people have been laid off, but that's the unfortunate thing where sometimes layoffs can be a good thing for a stock price, but usually, certainly for the long term, the stock price can go down if they have a struggle covering their debts. And if they never recover, they're never able to cover their debts, so they take on more debt to try to cover the short-term debt, then they could end up things like filing for bankruptcy or maybe selling off even more assets for things that really reduced rates because people know that the company's in trouble and can negotiate better things. So being able to cover your short-term debts is real important. It's important for us to be able to measure that. And the measures that we would use for that are called the current and quick ratios. And I'm going to show you how they kind of work here, but that's really the current and quick ratios measure a company's ability to service, or in effect pay, their short-term debts. So it's looking at short-term debts and their ability to pay that. They're easy to calculate. I'm going to show you that so you understand the underlying calculations and what the difference is between them. But they're easy to look up and have them calculated for you. And I'll show you that as well, where you can look these things up for companies so you don't have to do the manual calculations if you don't want to. And again, the key is they're looking at short-term, not long-term debt. Things like more like debt-to-equity ratios, things like that, consider more long-term debt. In these ratios, we're looking at short-term ability to pay their current debts and be solvent that way. So let's start with the current ratio. Very common thing that's used in investing is the current ratio. Sometimes it's known as the working capital calculation or working capital ratio. And it's a very simple calculation. You're basically taking your current assets divided by your current liabilities. So current assets would be things like cash, accounts receivable. That's money that people owe the company. They bought something on credit, for example. Now they owe the company money, so that's accounts receivable. Assets are things like inventory that you can sell off, and other assets are expected to turn into cash in less than 1 year. So that's the key. Current assets are things, and current liabilities are all things that are that's going to happen within 1 year. And these are things that you can be turned into cash, and then you can use that cash to pay your short-term debt. So current assets, and then you divide it by current liabilities, which are things like accounts payable. That's debt, or that's bills that we owe, for example. But they're coming to accounts payable. We have wages, so we owe our employees money, and that's coming up as far as liabilities. So we have wages, taxes that we got to pay. We got to pay taxes. And the current portion of long-term debt, maybe you have something that's, long-term debt that's like a 10-year note, so you got to pay off in installments every year. So a current ratio would look at what's the current year's, 1/10 of that basically would be considered as a current liability. The rest of the debt is further out from years 2 through 10. So what's going to happen in one term in the next year in terms of current liabilities? And the key to this, when you calculate this, when you look it up, the higher the number, the better. If I have more assets, particularly these liquid assets like cash and accounts receivable, inventory, all that we can use to cover our debt, more of those are better than having more debt. So we want a number above 1.0 ideally to show that we can at least cover our debts on a 1-to-1 ratio. But if we're at 2.0 or a higher number, that's even better. And it's also best to compare it against the peers, as in other companies in that sector or space. Somebody who's in defense contracts might be treated differently than an apparel company versus a technology company versus let's say like a consumer goods company. So all these things, now you can still compare them against different sectors, but it's a little bit fair to compare it within the sector. So that's the current ratio, looking at current assets versus current liabilities. Now, for some folks, they want to look at what's called a quick ratio. Sometimes it's known as an acid test ratio. And the idea of the quick ratio is you're looking at more current, even more liquid or more current types of things. You can see the formula here where you've got the quick ratio, and you're looking at cash or cash equivalents, things that can be readily turned into cash real quickly. marketable securities, so that's like stocks and things that they own, or bonds or things that they own that they can get money in from these other companies. So marketable securities, and accounts receivable, again, money that's owed to the company that's coming in, divided by that similar or that same current liabilities. All this happening within 1 year again. And the keys to the quick ratio is it's a more conservative number than the current ratio. So a quick ratio will always be less than a lower number than a current ratio. You both want them to be, above 1 ideally, but certainly a higher number the better. But your quick ratio will always be less than your current ratio. And the reason for that is it's looking at less assets. It's looking at assets that are more liquid, means it can be easily turned into cash faster and real easily without having to maybe take some price reductions or things on something. So that's why something like inventory, they typically will exclude inventory, because some inventory, especially finished goods, can be turned easily into cash, possibly depending on how your sales are going. And some might be a little bit more stagnant or not turn over, and their inventory turn over as quickly. Think about if you were a rubber manufacturer, right? You harvest and you make things out of rubber, and one of your big products is rubber tires that you sell to automobile manufacturers. But let's say the automobile manufacturing industry is hit hard and they're not selling cars, so they're not going to be buying your tires, and so you're not going to be able to generate that rubber into cash, or that inventory, especially raw goods like rubber, into cash quickly, or as quickly as something like a cash or marketable security or accounts receivable. So it's a little bit tougher number and more conservative number. Again, the higher the number, the better, and best to compare against your peers when you're looking at both current and quick ratio. So how do we look these? So now we know how to calculate them and the underlying basis of them. They're easy to look up too, and there's different tools you can use, but I'm going to show you one here that's a real easy tool to look at, and for screening stocks and for finding these numbers. And this is FinViz. You may have used it before. It's called FinViz. It's at finviz.com, FINVIZ.com. You can find it. And when you get to their homepage, you want to see where that first circle is there. You might click where it says Screener up in the upper left there. You'll find all these different screener things. And then you want to go down to this little bar across where it says like Overview, Valuation, Financial, Ownership, and all. There's a little line below. And then you just click the part where it says Financial, and then it comes up with this, what I'll show, then change above that, and you can kind of then sort it out by different things you want to screen your stocks for. So let's say I'm interested in consumer stocks, and things like food people would eat, for example. So I could say, and this is where it's highlighted in yellow there, these are the choices I made. I left everything else the same. Let's say I'm looking for things on the New York Stock Exchange, just the New York Stock Exchange versus the NASDAQ. I can leave that for all stocks, but I'm going to say New York Stock Exchange, and I'm looking at really large companies. So I'm just, for curiosity, I'm looking at large companies, and you can see it towards the middle there where I'm looking at consumer defensive stocks. Consumer defensive would be like stocks that are going to sell because no matter what's happening in the market, right? So people are going to buy food, people are going to buy household cleaning products or things like toothpaste, where something like a more consumer cyclical stock or discretionary stock, like let's say shoes, you don't have to buy shoes, or certainly a name brand shoes like a Nike, but you probably do want to buy some food, for example. So that's just how they organize these different sectors or industries. So I selected that, and then you'll see in the middle bar there where I've got this big red square there where it says CUR and quick R, that's your current ratio and your quick ratio. So you can stand the stocks, they would list them on the left, a whole long list of stocks, and you can kind of look at their current ratios. And when you do it, you'll see that. I pulled three of them out here just so we can kind of get a feel and look at them. And some of the companies are well known. So I have a Campbell Soup here. So you might know them for making soup. That's what they're famous for. So especially during recessions and things, people buy lots of soup. And you can see that they run a current ratio below 1.0. So it's could be a little scary, but again, they're a little bit more, they can kind of count on that money coming in regularly, so they can kind of manage around that. So current ratio 0.8 and a quick ratio of 0.5, getting pretty low there. But that's something to consider, like if you're comparing Campbell Soup versus other stocks, like let's say Hershey Chocolate, right? So Hershey Chocolate makes chocolate bars and good chocolate products, has a current ratio of 1.40. So above that 1.0 we're looking for, that's good. And a quick ratio, the more acid test or the more challenging or more conservative numbers at a 1.0. So in terms of their ability to meet their short-term obligations, they're really good shape. And then another one to compare would be like General Mills. They make cereal, like Cheerios cereal, for example. I believe they still own Yoplait yogurt, or if they sold that off, I'm not sure. But they own a lot of different types of food and packaged food type products. And you can see they're at a current ratio of 0.7 and 0.5. So if you're looking just at that number, you could say, in comparing these three companies, maybe you're thinking these three you might be interested in investing, and you'd say, well, at least as far as meeting its short-term obligations, a margin of safety, Hershey Chocolate would be the better bet in comparison to the other two companies. Again, also talking about comparing within its industry, I happen to look up Nike, for example, just for fun. And Nike runs a current ratio of 2.50 and a quick ratio of 1.80. You think about that, they need more of a margin of safety for a consumer discretionary stock. So if things go bad in the economy or Nike struggles for something, maybe they had a big shoe recall or some scandal, which they've had in the past, of course, too, as far as the manufacturing of shoes, they need to be able to meet their short-term debt, so they carry a little bit more cash and things on hand to meet those obligations. And thus their current ratio and their quick ratio are at 2.5 and 1.80 versus these lower numbers for these discretionary, or excuse me, these defensive consumer stocks, things that people are probably going to buy. So again, current ratio and quick ratio, great way to get a quick look at a company and its ability to meet its current debt. It's a great margin of safety tool, because even if the stock price is down, but if they got good current ratios and quick ratios, that shows that they're able to at least meet their obligations and then hopefully have a rebound. But you want to look at a lot of other factors too, of course, but this is two ratios that can really help you as far as understanding their short-term obligations and ability to meet them. When we talk about liquidity ratios, that's all about the short term. Debt ratios are all about the longer term. So where a liquidity ratio, like the current ratio or the quick ratio, is looking at current assets and liabilities, debt ratios are looking at more things of the overall or total picture than things like total liabilities and how they're able to service that. And one of the most popular in terms of debt ratios is the debt to equity ratio. In fact, things you have out there like PE or price earnings ratio that's used a lot. I think that one that's used also a lot from a lot of people is debt to equity ratio, because you're trying to see how much debt is out there and can the company service that debt, that long-term debt, and how does that compare to equity, which we're equity owners, we're owners of shares, and thus that's equity. So let's take a look at the debt to equity ratio, real common ratio that you'll be probably using quite a bit. First off, this is all coming off the balance sheet, like those liquidity ratios, and you're looking at the debt in comparison to the equity. So you're taking your total liabilities right off the balance sheet. What is the total? Not current. Now you're looking at total liabilities, and you're dividing that by the total shareholder equity. That's you and I as shareholders. How much shareholder equity do we have there? And we're comparing basically the debt versus the equity, because companies need money to expand and grow. A lot of that's coming from current income. That's where we want to grow, is from earnings per share. We want income coming in so they can then invest in the company, or maybe invest in us by giving us a dividend payout. So income is great. But this, we're looking at how much of our company is being serviced by debt, money we're borrowing, versus shareholder investment. And if there's a lot of debt, well, that's maybe not necessarily a good thing at all. And it measures that relationship between the amount of capital that's been borrowed, the debt, versus the amount of capital that's being contributed by owners or share owners like ourselves. We're comparing that debt to equity is what we're doing. And as that ratio increases, so as you have a bigger debt to equity ratio, the stock actually becomes more risky, because they might have trouble meeting that debt obligation or servicing that debt. If you can't pay your debts, well, what happens? You go into bankruptcy, right? That's a terrible thing. Or you got to continue to borrow more debt to service your current debt that's coming due, and it's this bad downward spiral. And you can sometimes see companies that they think they'll turn around, they say, yeah, we just need another quarter, another year, we'll be fine. We're carrying a lot of debt, don't worry. We got this new product in the pipeline, it'll be great. But meanwhile, they're piling up lots of debt. And if you see companies in comparison to their industry, where you want to compare once again, that are, or even the broader market in this case, that have these real high debt ratios, that should be concerning. So look for companies, when you're comparing them, that have low debt ratios is a good thing. Now, all companies, well, not all companies, many companies carry debt. That's okay, because they're borrowing money. They're going to invest that debt in equipment or factories, or maybe buy another company, a merger or acquisition, and looking at your ROE or return on equity, maybe they're going to take that debt and things will be great, because they're using this debt, and it's going to be they're going to make more on their debt than that they're paying out as far as interest on that debt and overall paying the debt back. is the idea. But that's like a smaller part. You don't want it to be a big number, especially in comparison. So overall, when you're looking at debt to equity ratios, bigger is not better in this case, bigger is badder. So lower debt to equity ratios or even no debt is a much better thing to look at. But don't be surprised. Most companies have some debt. Some debt is okay. Some debt is good actually to help fuel growth. But just watch out for those big companies or those companies with a big debt to equity big debt to equity ratio, because that could be really concerning. So in these big five categories where you can have different ratios like valuation and debt, whatever it might be ratios, there's also the section on profitability, which makes sense. We want to invest in companies that are profitable and that are using their assets wisely to continue to grow profits over a period of time, the period of time when we own their stock. And that's what we're really curious about and really want to key in on. And ratios can help us to evaluate a company as far as profitability and then compare with others in the industry and even the wider market, but really try to hone in on competitors within its own industry. And one of the more popular ones out there is return on assets, or ROA, right? You're getting this information from the income statement, the balance sheet. Formula on it is you're really looking at net income divided by the average total assets, or the total assets that are being carried, and looking at that in comparison to net income. Once again, these are formulas that will already be out there. You don't have to worry about calculating, but just good to understand, I guess, where they kind of come from. These different types of ratios. And this is really looking at assets. Assets are being things like a company owns, right? A company owns factories and equipment and different things that they own in order to conduct their business, right? So in order to do business, they have to have these assets that they own. And the ROA tells you how good is the company at making money and using those assets basically to make money. So if I'm investing in a new factory, or I'm buying additional equipment, or a capital expenditure to buy additional equipment, when I do that, am I getting a return on that asset? Am I getting a return on that investment in that asset? And that's what return on assets is looking at. So for example, if a company A has $10,000 in net income and owns $100,000 of assets, well, then it would have an ROA of 10%, which is nice, but doesn't mean anything until you can maybe compare it to others. So if another company, let's say, has the same thing, but it's $20,000 in net income for that same $100,000 in assets, well, they now have a 20% ROA, the bigger number. And the bigger number shows me that they're using that same amount of assets more effectively. Now, as we know, there's companies of various sizes within industries. So by using a ratio, we can now compare maybe a bigger company to a smaller company and compare how they're each using their own assets effectively as one ratio of many others that we might use when we're analyzing stocks to buy. So for ROA, or return on assets, think of it as for every dollar of assets you own or the company owns, how much in profit can it generate in profits each year? Maybe around 10% in profits is a good rule of thumb with ROA. So ROA, or return on assets, the whole thing you're looking at is a bigger number. So if I have company A has 20%, or in this case, company A had 10%, and company B, if we had a fictional company B, was 20%, well, that's at least telling me it's using its assets more profitably. That doesn't mean the other things are going good, like its price earnings or its dividend yield or what the future might hold. Those are other things, but we can at least say, at least this management team's pretty good at managing and using its assets. That's a good sign, because that means they have a better chance to be profitable than a company that is less efficient or less efficient with their assets. Another profitability ratio is return on equity, or ROE. Similar like to ROA, or return on assets, you're looking at how effective is the company being managed, how effective is the company. And you're really looking at it from a profitability standpoint. That's why it's in the profitability ratios category. So ROE, or return on equity, you're looking at the income statement, the balance in the balance sheet, and you're looking at net income dividing by the average shareholder equity. So where ROA was all about assets and how effective we're using our assets, that is taken out in this equation. This is about shareholder equity, basically what we own. We're the owners of the company. That's the equity, is another word for ownership, so to speak. And really ROE is saying how good is the company in rewarding its shareholders? How much money are we making per our dollar or per our investment? So as an investor, ROE is something we're very concerned on. We want to make sure that companies are giving us a good return on our investment from an operational standpoint, or return on equity. So for example, if a company, let's say company B, reported $10,000 in net income, right? So that's great. They got $10,000 in net income, and the shareholders have $200,000 in equity. So in that shareholder equity, there's $200,000 out there. Its return on equity is thus 5%. So for every dollar of shareholder equity the shareholders own, the company is generating, in this case, 5 cents in profits each year, right, or 5%. So my return on my equity that I put in there, I'm getting 5%. Now that may not necessarily be reflected in the stock price or my return on my actual stock price, on my stocks going up or down. There might be other factors there, but this is another way of measuring, effectiveness of an organization. And this is looking at not from an asset standpoint, but looking at from a shareholder investment standpoint. So like return on assets, return on equity, the higher the number, the better. So if you're looking at two companies and one has a really high return on equity compared to the other, that is a good sign that they're really giving you a good net income, giving good earnings and good things compared to, this other company. So in terms of profitability, ROE and ROA, return on assets, return on equity, higher the number, the better. Return on invested capital, or ROIC, is a real key thing for investors, particularly value investors. It's a great way to measure companies. Charlie Munger, who is a partner and associate with Warren Buffett, famous value investor, he really relies on this primarily as his main way of looking at things. And he has a great quote around that. And we'll look at how it's calculated in a little bit more here in a second. But he said that it's obvious that if a company generates high returns on capital being like cash or investments, and reinvest at high returns, it will do well, right? If we're able to generate a lot of money and then we invest that money back in the company or reinvest in the company and we keep generating high returns on that, the company's going to do well. And then he adds on this, but this wouldn't sell books, so there's lots of twaddle and fuzzy concepts that have been introduced that don't add much. Well, hopefully a lot of things you're learning in the course is not a bunch of twaddle, or fuzzy concept, but this is where he really relies on this ROIC, and the concept behind it is if I take money that I've made as a company, think of myself as a business owner, I've made money, I now take that money and I then reinvest that money in my company, things like research and development or expansion or new factories or employees or whatever, I'm reinvesting that money, and my return on that money is even bigger and keeps growing over time, by generating more profits, then that's going to be, I'm going to do well as a company. And that's a very obvious kind of thing. And we can measure that. And we actually have some formulas we'll look at here at the end of this lesson about how to actually measure that. So let's look at an example. So going back in time, Apple made a lot of money on the iPod. You remember the iPod? It was 10,000 songs in your pocket was the marketing, or 50,000, I can't remember the number, but it was really revolutionary. But it did have a life cycle like a lot of technology types of things. But they invested, the money they made in the iPod into more research and developed other very profitable products such as the iPhone and iPad, which were even more profitable and continue to be and are extremely successful. So Apple, you'd say, would have a great ROIC, return on invested capital, because they made a lot of money on the iPod, reinvested that, particularly in research and development around these iPhones and iPod, which were at some point in the gleam in somebody's eye and later now become something you and I, really have a hard time living without, which would be like a smartphone. And there's certainly competitors that have grown up around that. But that's a great return on invested capital for Apple. So if we think about what is ROIC and what we're trying to measure here of that concept of reinvesting that capital, is it's kind of it's a profitability and performance ratio. It's a measure to say, it's a ratio that we can then compare companies with. Who's doing a better job of reinvesting its capital? Just like you have price to earning ratios and PEG ratios, this ROIC is a ratio to compare performance. How is the management team reinvesting how well are they doing reinvesting, their profits? And it measures the percentage return of investment in the company by the company itself. So this is not stockholders, this is the company in reinvesting its profits. They could reinvest those profits, they could pay the profits out as a dividend. They could, use profits to reduce their debt. Or they can reinvest in things like research and development. Either way, they're looking at ways, what is the percentage return for that money they made in their reinvestment? And it's really also a measure is how efficiently is the company using investment in it to generate income. So think of us as, we're investors, so we're providing them with investment income, as far as the original stock offerings and stuff. And, but from their profits, how efficiently are you using that money and how much return are they generating? How profitable are they doing? So that's kind of that, what is ROC? Think of it as a ratio that's looking at efficiency, profitability, and how well they're using the money that they generate. So how do you calculate this? And when you look up stocks, there's ways to find on Morningstar, Yahoo. You can find ROIC, or return on investment capital. You can compare it against other companies within an industry. And a company, let's say, that's really gone down in stock price might be still doing a great job as far as investing, and that might be a company ready to rebound because they've got a good return on invested capital. As far as how the ratio is really calculated, you're basically looking at net income, the money coming in, divided by what they have for capital, which capital is debt and equity, right? That's how you capitalize the business. Debt, you've taken on money, and equity is like stockholder equity, money that's been invested in the company that's there, and they're using that net income to add to their capital, basically. And how are they using that? And alternatively, the way to calculate that too is you can take net income less the dividends, because remember, dividends are a payout back out to stockholders. So that net income is reduced by the amount of dividend payout. Net income is the money I've made, but I'm going to take a portion of that and give it to our stockholders, thanking them for being a stockholder. Here you go. Here's some money for you, usually on a quarterly basis. And now we're going to use that number as far as net income, dividing it by our debt versus our existing debt and equity. As one way to do it, there's actually a couple different ways to do it. One is using NOPAT, which is the return on invested capital using net operating profit after tax, or NOPAT, and divided by invested capital, or equity, how much has been invested here. So really looking at profits, but also factoring out taxes, so that we're reducing it as a different number, looking at it after taxes. So that's another way to calculate it. Kind of getting to the same thing, same idea, just another way, a different way to calculate it. And then here's even a different way to look at it. We're looking at ROIC, looking at that operating income, how much we're generating, with the factor of 1 minus the tax rate. Basically, you're trying to factor out, you're having a factor for tax rate in there. And you're looking at the book value of invested capital. What is the book value of the company? What's it worth, from an invested capital standpoint? And book value consideration, the argument around this is that book value is better than market values, incorporating future growth consideration, with markets generally being more forward-looking. So with book value, you're looking at what is really our state today, where actually as investors, we want to usually look at things like market value. What is the future earnings and growth? We want to look at that. But if we're evaluating the existing management team on what they're doing right now with invested capital, how they're investing that operating income, for example, comparing to book value is a better measure, a more fair, more conservative measure, actually, than looking at market value. So there you have, different ways of calculating return on invested capital. But if you go back to that quote there again from, Charlie Munger, the big idea, and however you calculate, you're going to get kind of the same area, say the same way, is how is the management team doing investing the money that they've made from their profits, and then we can compare that so companies that have good ROIC, have better future prospects than maybe those who didn't. Who's the folks who are taking their iPod type product, investing that to come up with a new iPhone, for example? I'm going to show you how to look up these different types of ratios very easily on free site, and we'll use Pfizer as an example company, just a big pharmaceutical maker, known for vaccines, I'm sure, of course, so COVID vaccines. So let's take a look at Pfizer and some of their fundamentals, and really it's just a guide to show you where to find this information for free. Okay, I'm over here at finance.yahoo.com. And we're going to look up Pfizer here. You just type right in the search here that you can type in their full name, Pfizer, or if you start typing, you'll start seeing it come up, or their ticker symbol, which happens to be PFE, shorthand to look up stocks. So I'm going to click on Pfizer here, and I'll bring up the Pfizer quote. Another good site that's easy to use too is investing.com, and I'm just going to go there real quick, and you just put in the same thing, PFE or Pfizer, or however you want to do it, and it'll bring it up. Now, one nice thing about investing.com is they actually will do more in different types of currencies and different stock exchanges than Yahoo Finance. So you can see this is Pfizer PFE, but it's on different stock exchanges, the New York Stock Exchange, Buenos Aires, Stockholm, Hamburg, all this different stuff. And when you choose something like, let's say Hamburg, for example, in Germany, it's going to bring up the Pfizer quote, but it'll bring it up, if you can see right here, in EUR or in euros. So that's a good way for, depending where you live, maybe to find something that's more reflective in your currency.
But for this, we're going to use Yahoo really just for demonstration purposes, to look up this information. Your broker might have this information on their online site too as well. So let's look at some of these different fundamentals and interpret how it might be going for Pfizer. All right, so here's Pfizer, and they have a good day at 5.3%, so good for them. So on the first part, this summary area is what should default to come up. You can see the 52-week range. You can see right now when I'm recording this, it's up near its high for the 52-week range. If we look at the PE ratio, now let's look at some of these ratios. PE ratio, TTM, means trailing 12 months, so it's looking backward as opposed to forward. So the last 12 months, its PE ratio, is at 15.88, which is about average for the larger, let's say, large cap USA stocks run right around 16, 15.9. So it's not real high as far as a PE ratio like a technology company might be. It's kind of right in the middle. So that's pretty good actually for a company that's near its high and doing well, Pfizer. You can also see dividend here. This is now forward looking. This is anticipated what the next dividend looks like. So forward dividend and yield, right? So the dividend is $1 or 1.56 or $1.56 cents would be what you get paid per share. So if I bought one share at, let's say, at $55.55, then I would get a dividend of annual basis, and that's paid out quarterly, but that's the annual dividend 1.56. That's why yield, which is the next number in this bracket, is good to look at, because it gives you a good percentage so you can compare stocks easy. It's hard to compare the actual number, where it's easier to compare the yield in terms of that dividend yield and what you're kind of getting for the price you're paying. So 2.96 is slightly above the S&P 500 largest U.S. stocks average, so it's a nice dividend payer. If this was a company that did not pay a dividend at all, by the way, it would say like NA here, like not applicable, or might have 0. All right, so that's a couple things. Let's look at some more ratios here. I'm going to go under statistics here. I'm just going to click on statistics, and it'll bring up all sorts of information, all sorts of ratios, all sorts of numbers you can look at. This column is current right here, and then you can look backwards. So if we look at, this is forward PE ratio. This is what they think it'll be going forward. So as far as some analysts and things, so that's actually a little bit lower. But the main one most people look at is the backward one. That's at 15.89 we're looking at. The PEG ratio, which we like because price to earnings plus a growth number, this is a 5-year expected growth, 1.60. And as you remember for that lesson, we're looking for something less than 1.0 is terrific. That's for a PEG ratio. But this isn't bad at 1.6. That's for a price you're paying for its earnings growth, not bad at all. Price to sales actually is very good. You're looking for something below 4, certainly below 1.0 is fantastic when you're looking at price to sales. 4.32 for a big brand name company, it's been in the news a lot, and as a well-established dividend payer, that's price you're paying for the future sales is not bad at all. So that's where you can find that. Oh, by the way, price to book is another measure out there. Price to book, that's its value. If you're looking for something, value investor, somebody looking for a stock on sale or on discount, would be looking at something below 3.0. Below 1.0 would be amazing. That means its assets and all that is worth more than the price that you're actually paying for it. Just a shorthand version of that. So anything under 3 is great, and 4 is not bad either. That's pretty good. So you're not paying something that's like a 10 or 12 as far as the price relative to its assets. And again, or its book value. Again, this is all information you can weigh against each other, right? You don't have to say, well, I won't buy this because it's at this number, or I only buy stuff that's at a PEG ratio below 1.0. That could be fine if that's your strategy, but understand this isn't too bad at 1.6. If we look at some of these management effectiveness, I'm going to scroll down here. We've got a return on assets, return on equity, TTM. What was that again? Trailing 12 months. This is backward looking, so you get a feel for how they've been doing. So we're looking for something above 5% in return on assets to be good. 7.78 is above that. That's good. If you're above 20%, that's amazing. That's really terrific. But this is pretty good in general. Not excellent, but good. Return on equity, anything that's looking above 14% is good. This is so 27.75. That's a good number. So these are management effectiveness are pretty solid numbers. Let's look at their debt now. We're going to go down here to their balance sheet. And if we look at their total debt, if we look at the debt to equity, MRQ is most recent quarter. So this is more current information, most recent quarter. It's past looking, but it's most recent. 52.5 for a debt equity ratio is very high. as far as debt equity. You're looking for something below 2, maybe below 3. This is very high. However, highly leveraged or companies that do a lot of borrowing that can generate a lot of cash flow can handle that, and they can pay their current debt. So this is where you look at this number and say, wow, that's really high. Can they pay their current debt, or is this going to be a problem? And so that's where we'd look below at the current ratio, most recent quarter, being above 1.0. That means they're able to pay their debt. This is a number where you definitely want to be above 1.0. Otherwise, if it's below 1.0, that means they're having troubles paying their current bills. 1.38 is fine, right? So they're able to pay their current bills, carrying a little bit more debt. But one thing to look at too is they've got a lot of cash on hand, $29.7 billion in cash, right? And their total debt's $39 billion, a little over 39, let's call it $40 billion. So they can actually service that very well from the cash they have on hand, or a lot of it. And if we look at their cash flow, how's money coming in? You can see they're generating like 32 trailing 12 months. They're generating about $32 billion in cash. So they're not in a problem as far as being able to pay off that debt over that long term. They're using that debt to finance things like expansion and probably a lot of money into research and development. Thus, why they were able to come up with a COVID vaccine very, very quickly. In fact, if I'm looking at this numbers, I might say to myself, I bet they have a good dividend payout ratio. We know they pay a decent dividend, around 3%. How's their payout ratio? I bet it's pretty good because they generate so much cash that they can pay that dividend. So we go under here under dividends and splits, and forward-looking annual dividend rates at that's the number. That's the 1.56 per share. We're looking at that yield. So looking forward, we're expecting a 2.96%. Trailing the last 12 months, annual dividend yield is 2.94, so pretty steady. 5-year average is at 3.69. So why is it less now, even if they've been raising their dividend? It's because their stock price has gone up. Remember, dividend yield is a mathematical formula, and so since their stock price has done well, that's reduced the percentage yield on that dividend. So if you bought 5 years ago, you were getting a nice dividend at 3.69, probably a good price on it. And here's what we were looking for, is that payout ratio, and it's at 45%. Remember, we want to be at least under on a dividend payout ratio. Under 70% would be good. Really, anything under 50% is excellent. I mean, if you can get under 50%, that's excellent, and they are at 45%. So that's really, really good, right? So I would say, Pfizer would be a company that's trading near its high as far as the stock price, but has a real good, solid dividend, really can make their payments, and whether it's a current ratio, and make their dividend payouts. So if you're looking for, a quick look, you'd have to do more due diligence, but a quick look, this would be a good dividend paying, type of stock would be Pfizer. So with that would be a kind of a view, and you can look at some of these other different things here. Like if you click on profile, it'll tell you more about what the company does and where it's located, and a little description of the company and all that, and where they're headquartered. So with that, that's a quick way where you can look up these numbers and how to interpret them, in very, very quickly. So with that, practice on your own, play with your own stocks, see how they look, see how they compare to Pfizer, and use those ratios and understand them. And I wish you all the best of luck as you're looking at these ratios, and use them as far as a way to evaluate companies from a quantitative standpoint, and how are they doing with their performance in terms of the ratios.